Breaking news, the restaurant apocalypse of 2025 is here, and it's worse than anyone could have imagined. Major chains that have been around for decades are now teetering on the edge of bankruptcy. Would you believe that some of America's most beloved restaurant brands might completely disappear by the end of this year? The restaurant industry is facing unprecedented challenges with rising food costs, labor shortages, and changing consumer preferences, creating a perfect storm that's threatening to sink even the biggest names in the business. Today, we're diving deep into the 15 major restaurant chains that are in serious financial trouble, and the numbers are shocking. Let's start with Applebee's, which has closed over 200 locations since 2020. The casual dining giant is struggling to attract younger customers, with recent market research showing that only 12% of Gen Z considers it a dining option. Their parent company, Dine Brands Global, reported a 15% decline in same-store sales in the last quarter, and their stock has plummeted 35% since January. Red Lobster, once the crown jewel of seafood dining, is drowning in debt. Thai Union Group, their parent company, recently announced they're considering selling the chain after accumulating over $900 million in losses. With seafood prices soaring 40% in the past year, their famous endless shrimp promotions are now costing them more than they're bringing in. Pizza Hut is facing perhaps its most significant crisis since its founding in 1958. They've already announced plans to close 500 dine-in locations this year alone. The rise of delivery-focused competitors and ghost kitchens has left their traditional restaurant model obsolete. Their parent company, Yum Brands, reported that Pizza Hut's same-store sales decreased by 18% in the first quarter of 2025. Boston Market, once a household name, has filed for Chapter 11 bankruptcy protection for the second time in its history. They've already closed 150 locations in the past 6 months, with plans to shutter another 100 by year's end. Their inability to adapt to changing consumer preferences and rising costs has left them with unsustainable debt levels. Ruby Tuesday continues its dramatic decline, with only 209 locations remaining from their peak of over 900 restaurants. Their attempt to rebrand as a more upscale dining destination has failed to resonate with customers, and they're now facing potential bankruptcy for the second time since 2020. TGI Fridays is another casualty of changing times. They've recently announced the closure of 100 underperforming locations, representing 20% of their U.S. presence. Their dated concept and inability to attract younger diners have led to a 25% decline in revenue compared to pre-pandemic levels. Subway, despite being the world's largest restaurant chain by number of locations, is facing serious troubles. They've closed over 2,000 locations in the past 2 years, and franchisees are reporting record low profits. The introduction of their new meat slicers and menu items hasn't stopped the bleeding, with same-store sales down 22% compared to last year. Golden Corral's buffet model is proving unsustainable in today's market. They've already closed 200 locations permanently, and their remaining restaurants are struggling with rising food costs and changing consumer habits. Their average customer age is now over 50, suggesting a failure to attract younger generations. Friendly's has seen its restaurant count drop from over 500 to just 130 locations. Their recent attempt to modernize their menu and appearance hasn't reversed their fortune, with same-store sales declining 28% in the past year. Steak 'n Shake, despite being acquired by Big Larry Holdings, continues to struggle. They've closed 300 locations in the past 3 years, and their new counter service model hasn't gained traction. Their debt has ballooned to over $153 million with no clear path to profitability. Qdoba Mexican Eats is facing intense competition from Chipotle and local Mexican restaurants. They've closed 150 locations since 2023, and their parent company is actively seeking a buyer. Same-store sales have dropped 20% year over year. Chuck E. Cheese's parent company emerged from bankruptcy in 2021, but they're still struggling to adapt to modern entertainment preferences. They've closed 150 locations permanently, and their remaining restaurants are seeing customer traffic down 35% compared to pre-pandemic levels. Perkins Restaurant and Bakery has closed over 100 locations in the past year, with more closures expected. Their breakfast-focused concept is facing fierce competition from newer, trendier brunch spots, and their core customer base continues to shrink. Luby's Cafeteria, a Texas institution, is in the process of liquidating its assets after years of declining sales. Their cafeteria-style dining concept has failed to attract new customers, with sales down 45% from their peak. Finally, O'Charley's has closed 100 locations since 2022, with plans to close an additional 50 this year. Their attempt to revitalize the brand with new menu items and renovations hasn't stopped the decline in customer traffic. These struggles reflect broader changes in the restaurant industry. Rising minimum wages, increased food costs, up 28% since 2023, and changing consumer preferences are creating an environment where traditional chain restaurants struggle to survive. The average cost of opening a new restaurant location has increased by 40% since 2020, making it harder for these chains to expand or renovate existing locations. Digital ordering and delivery have become essential, but many of these chains were slow to adapt. Third-party delivery fees, which can eat up to 30% of order values, are further squeezing already thin margins. Meanwhile, ghost kitchens and virtual brands are capturing market share with lower overhead costs. The labor market continues to be a major challenge, with restaurant worker wages up 15% year over year. Many chains are struggling to maintain adequate staffing levels, leading to reduced hours and lower customer satisfaction. What does this mean for consumers? Expect to see more empty storefronts in your local shopping centers, fewer traditional casual dining options, and potentially higher prices at the restaurants that do survive. Some of these chains might be bought out by private equity firms, while others will simply disappear. For investors, this represents both a warning and an opportunity. While traditional restaurant stocks might be risky investments right now, companies focusing on restaurant technology, ghost kitchens, and delivery infrastructure could see significant growth. The restaurant industry is clearly at a crossroads, and these 15 chains represent just the tip of the iceberg. As we move further into 2025, we'll likely see more chains facing similar challenges. The question isn't just which restaurants will survive, but what the American dining landscape will look like in the years to come. What do you think about these changes in the restaurant industry? Have you noticed any of these chains struggling in your area? Let me know in the comments below, and don't forget to subscribe for more updates on the changing business landscape.